Hey everybody, this is John and welcome to the free video. So let's dive in and take a look at a couple of key stocks here. And what we're seeing is that we're stocks that have paused and are taking violent reversions to the mean back to the 21 period moving average on the weekly chart, which means on a daily chart we're blowing through lots of levels. You got the 21, you got the 34, you got the 55 and the 89. Now a close below the 89 actually opens up a trend reversal. And a lot of times an 89, a lineup on the 89 will line up with the 21 here. And so these are levels that if they hold, that's great. That's just the next pullback in the inevitable continued march higher. But what we want to keep in mind is that if this is something, this also could be the start of something bigger to the downside. As I talked about in the premium video, we've got two very key internal indicators that are not bullish in any way, shape, or form. So we want to be very careful on the long side here with the assumption that we want to buy these dips. Okay, a lot of this has to do with sector rotation. Money at this point is fleeing semiconductors on a short-term basis, okay, as hedge funds are kind of managing their portfolio and going into things like American Express. Okay, this is something where funds are looking at this and saying, you know what, we are underweighted here, we're overweighted in semis, we have got to correct this. Okay, or what about energy? Energy is experiencing a lot of inflows right now, so get out of these overpriced FANG stocks. And you know that's you know, the overpriced or underpriced is debatable, but in terms of value, it's like, well, gosh, the sector XLK is extreme. Okay. Whereas it's through, you know, all these extreme levels, and when it gets that extreme, there's automated systems out there in the black box area that will start selling those for a reversion back to the mean, and it moved back to the 8 period moving average. It's a minor one, but more typically you'll get something lining up with the 21 period moving average. Okay, so that's what we're seeing. That money is flowing into Costco. All right, so that's just the biggest thing to keep in mind, is that what's happening in this kind of a market is you're getting very aggressive sector rotation instead of hedging with a VIX. Okay, and that causes some interesting movements here. And another good here, just a stock of net inflows, is Wynn. So Wynn Resorts, while money flowing out of semis and tech, it's holding up here just fine. So let's kind of take a look at some of the ideas around how to spot these rotations before they happen, because obviously it's easy to spot them after the fact. So really there's two kinds of things that we're looking for here. One is that you get a sustained run, and at some point something happens that says, okay, this, think of a black box system that triggers, that says, all right, this thing has moved so far that we have got to rotate out of this and possibly short it for a reversion back to the mean. And on a weekly basis, you got to remember, these funds don't have the liquidity to do this, you know, on a 30-minute chart or something like this. They're looking at weekly charts. And so reversion back to the mean, the 21 period moving average, that's a substantial move from about $270 down to in this case, around $230. Okay, that's a big $40 per share move. And then from there, they could start look at rotating back into it, but they'll only do so if they see that the, you know, selling is done. You know, they're getting in early. And so then the question becomes, well, how do you, you know, pick up those triggers up here? Okay, because you don't want to short here and just get in front of a freight train. Why would it be okay to short up there? So this is what we call sector rotation, or reversion to the mean type trading. And you can see that these are the signals where the black box systems start getting short. Okay, they're going to start shorting early. They're not going to sit there and wait for it to roll over, because at that point, a lot of times, especially for big funds, it's too late to get in. They just know that at this point, the upside from here is very minimal, and the odds have increased exponentially of a reversion to the mean. Okay, and what they're looking for here is a reversion to the weekly mean, and as we can see, that's here at the 21 period moving average. And you can see the same thing here on XLK. Now notice that there's two areas here. First, you had some areas here, and again, just think of it as these are areas where institutions are starting to leg into shorts, and then here's their payoff. Okay, and of course, while they're legging into shorts here, they're legging into longs, like say an energy. And here they're doing it again. Now, this here we came back to the 21 period moving average on the weekly. Right now, if memory serves correctly, we're only at the 8, which means we have more room to go. So let's take a look. Yeah, so here was the first one where we did manage to go all the way back to the 21, and then here so far we've gotten the signal, but we've only gotten the 8. So we essentially have some more significant potential downside. And keep in mind that the same concept works in reverse when it gets to a point where it's too extended to the downside, and it starts triggering black box systems for reversion to the mean back to the upside. And then last but not least, while the institutions are doing this on the weekly level, from a day trading perspective, we can also change the parameters here to fit the black box systems that are doing this on a smaller level. So here, black box buys, meaning that you can start, and if you think of it this way, it's like, okay, we're going to do 10 lots, so, or you buy one option here, buy 2 here, 3 here, 4 here, 5 here, and then when you get confirmation, you could get into the rest, or just keep buying them down there to a full level. And then when you start seeing them up here, it's the idea like, all right, the main part of the move has been here, and now they're going to start legging into shorts. Okay, and then boom, that's when they get paid. So that's the general concept there. So I will be doing a free webinar about all of this on Thursday and taking a deeper dive. So Thursday, December 7th, that's 7 o'clock Central, 8 o'clock East Coast time. And if you go to simplertrading.com/hedge, now you can use that tool as an indication that you should hedge, but you can also use that as a tool for new trades that are more based on reversion to the mean, so you're trading in alignment with these big black box systems out there that are doing very, very active sector rotation and also rotation within the biggest stocks within each sector. Okay, it's a very, very real, very, very profitable reversion to the mean type strategy that's starting to get more intense. So the early warning signals that we're talking about, those are the ones that are starting to predict those quick kind of brutal pullbacks that can kind of knock the wind out of your sails if you're not ready for it. Also going to show you a layout that kind of x-rays all the sectors at once, so you can see kind of real time how the money is flowing in and out of those sectors. How to look at those volatility spikes for those kind of the faster gains if you're just looking for day trades, and also keep it in mind that you can do this on a smaller term basis and do 1 and 3 hour trades or even shorter based on signals that are geared more towards 5-minute charts. Okay, so anyway, it's fun. It's been something where I'm seeing the market more and more go into this flow simply because that is the institutional way to hedge this market. All right, that's why the VIX is not spiking up. Anyway, it'll be a lot of fun and looking forward to seeing you there.